story of the hour. Jump onto the chart. Is this the beginning of a massive financial unraveling? We got to add a little addendum to the show map today. So we start here on the daily. Now, we've been looking at the RSI on Bitcoin's daily chart for the last several days. It always has been, but it's been increasing over the last 50 years since the government has been getting. Hey guys, what's going on? Jeb here, and welcome back to Coffee and Crypto Live. This is your weekdaily morning show where we bring you the latest and everything Bitcoin and cryptocurrency. And in today's episode, we are going to be talking about none other than the Federal Reserve. It is official, and I'm going to show you in just a second. It is official. 25 basis points has been cut from the effective federal funds rate. And on top of that, we also have early reports that we are going to be seeing quantitative tightening ending on December the 1st. This is extremely bullish news. The last time that we saw quantitative tightening and we saw Bitcoin trading at between $3,000 and $8,000, and within 24 months Bitcoin would rally almost 20x all the way up to approximately $69,000. So today we're going to be looking at this, and we're going to be watching Jerome Powell's actual speech here and Q&A here at 2:30. So let's go ahead and go over what has happened. October FOMC decision is here. The Fed cuts rate as expected by 25 basis points. There were two dissents. Schmidt favored no cut, and Mirren wanted a 50 basis point rate cut. The Fed will end quantitative tightening on December the 1st. Mortgage-backed securities redemptions will be reinvested into Treasury bills after that. The statement changes mostly the market outlook, notwithstanding available data and recent data. As you can see, this is the actual post from the Federal Reserve here. You can pause and look at this if you want to. They've been talking about achieving maximum employment and inflation down to 2%. They're strongly committed to maintaining maximum employment and returning inflation to its 2% objective. So, very excited to be here today. We're going to be looking at what this is going to do to the charts. Right now, Bitcoin is experiencing just enormous volatility, as we talked about. Full transparency, I do want you guys to know whether we succeed or lose. I went into a long trade right here. I went long literally right there. Our liquidation price is down at 109,500. Our target is up towards $116,000. So we are currently long. I'm actually going to see if I can pull up that long right now. Just figured I'd do a little fun long on the Fed announcement. I'll go ahead and show you here. We went long over here. We're up 7%. We have an entry price at 111,146. And as you can see, our entry was, my gosh, I was sitting in line getting a sandwich, and I said, you know what? Let's go for it. We went along right there, and this is what's happened afterward. Now, of course, we do have these early reports that quantitative tightening is ending. We're going to be looking at this ourselves to confirm that report. Once again, I was very careful to use proper language. I did say early reports. We don't. We need to fact check and make sure that the person that posted that tweet is correct. But from what I can understand, there have been announcements of QT ending. So we're up a little bit right now. You know, it's not a huge position, but we're just doing this for fun. We are going to go ahead and do some more research here and just make sure that what we are being told is correct. So we're going to be doing a little bit of an unorthodox stream. We're going to be doing our own analysis as it stands. Let's go to FOMC. Let's pull up the minutes. See if I can find the minutes for this meeting. Here they are. Okay. I got the PDF. All right, here we go. Here's the statement of the minutes. Let's read them ourselves and make sure that we are getting news from the official source. The way you find this, by the way, is you go to federalreserve.gov/monetary policy, all that. You can basically type in Fed minutes, and you're going to see a website like this. These are the minutes. What's a minutes? I didn't know that for a long time. Minutes is basically this is the statement that is being discussed today. So, by the way, if you're new here, my name is Jeb McAfee. I've been working in the cryptocurrency space for over 8 years. I've been an investor in Bitcoin since it was trading at $3,000. I love you, and I want to see you succeed. Hit that subscribe button and stay tuned. We got a lot to talk about. Let's go over this actual official statement here and see if there are any. Yep, there it is right there. The committee decided to conclude the reduction of its aggregate securities holdings on December the 1st. It's true. It does say that. Okay. We needed to fact check and make sure that tweet that I was seeing was accurate, but it says it right there. The committee decided to conclude the reduction of its aggregate securities holdings on December the 1st. Okay. Now, here's why you're wanting to watch this stream and not all the other ones on YouTube, because I'm going to explain what that means and why that's so important. Quantitative tightening, what is it? To explain what quantitative tightening is, we have to explain something called the balance sheet. So, Whether you are an individual or whether you are a company, you have what is known as a balance sheet. And there are different assets that you hold on that balance sheet. In your balance sheet, for example, you might have your home, you might have your Roth IRA, you might have your Bitcoin, you have your cash holdings. You have all of these different assets sitting on your balance sheet, and those assets that are sitting on your balance sheet help you to it's basically your net worth, right? Minus liabilities, it's your net worth. I'm going to go ahead and leave the chart up here, and we'll watch Bitcoin on the 1 minute chart while I'm kind of explaining this. The Federal Reserve has its own balance sheet, except instead of having a few $100,000 or a few $1 million like a lot of you guys, they've got like $7 trillion on the balance sheet, and all of those funds and all of those assets that they hold on the balance sheet are not, I repeat, they are not real. They are assets that were purchased by the Fed with money that doesn't exist. And so when you see QE and or QT, let's just go up to a 2-layer panel right here so we can keep an eye on Bitcoin. We'll have Bitcoin right here. We'll look at USCBBS over here. When you look at the United States Central Bank balance sheet, you can see this is the balance sheet. This is the 1 minute chart price action on Bitcoin. If anything crazy happens, we'll jump on over back talking about that. I'm in my trade entry down here at 111,100. Not a terrible place to enter into a trade entry, but I want to explain why this is important. So the last time we saw the balance sheet stop getting smaller was right here. This is when it happened. This was the last time that QT stopped. That was September the 16th, give or take, 2019. Let's pull up the chart, and I'll show you where the market was the last time the quantitative tightening ended and why this is so important. Remember, we said September of 2019. September of 2019 was right here. And in fact, you can see this if we overlay USCBBS. And we're kind of getting all this charting stuff out of the way before the meeting, because we'll be actually listening to and commentating on Jerome Powell's announcement. You can see quantitative tightening ended right here, which led to QE, which led to a major blow off top. Now, I'm not saying that we're going to see the exact same thing that we had happen last time. The last time we saw QT stop, within 2 years, Bitcoin was 700% higher. I'm not necessarily convinced that that's what's going to happen. But what I do believe is that with QT stopping, you're almost certainly going to see QE coming in sometime in 2026. It might be December of 2026. It might not be immediate, but there's most likely going to be some level of quantitative easing. And as we've seen in past, when quantitative tightening stops, it's almost always very bullish for the Bitcoin market. And the best way that I can explain that is this. When quantitative tightening stops, it's a little bit like taking your foot off the brake of the economy. This balance sheet, the Federal Reserve's balance sheet, is exactly what is exactly the thing that it's one of the two major drivers of inflation. The first of which being fractional reserve lending at the banks. Now it's not even fractional, and then also we have the balance sheet. So this is funds at the height up here is $9 trillion of funds. Right now it's $6.56 trillion worth of funds. These are funds that are in the United States economy that don't actually exist. What the Fed does is they come on their little computer and they typey, and they buy two different types of assets, mortgage-backed securities and treasuries. Well, the treasuries are basically a loan that the Federal Reserve is giving to the federal government. And when you purchase mortgage-backed securities, you are propping up the mortgage industry. Who profits from the mortgage industry? The banks. So when quantitative easing is taking place, it is a way of the Federal Reserve printing money out of thin air to give that money to the banks and to the federal government. And so when they stop rolling it off, what they're basically doing is they're saying, we are no longer going to stop, and forgive the double negative, but this is the easiest way to explain it. We are no longer going to stop giving the Federal Reserve and the banks money. Why does that matter? Because when you have quantitative tightening going on, this is a net drain on mortgage-backed securities and on the federal government. Well, that sounds like a good thing. Why shouldn't we just quantitatively tighten into oblivion? Honestly, I think we should. The balance sheet should be zero because all of this is fraud. Literally every single penny that's on the balance sheet is complete and total fraud. It is counterfeiting. It is ridiculous. It's awful. It's terrible. The reason that we're kind of excited, though, on the short term about QT ending is that when QT ends, generally you see QE, which is quantitative easing, which is the purchasing of treasuries and mortgage-backed securities with money that doesn't exist, which leads to, you guessed it, inflation. Well, guess where people go when they don't like inflation? They go towards Bitcoin. But when you see the cost of capital go down with interest rates going down, you also see people flood into stocks. And so when people flood into stocks, what do? Well, they flood into Bitcoin, because Bitcoin and the stock market is positively correlated. And so there is a major correlation right now between what is going on at the Fed and what is going on in the stock market. And you can even see that over the last few days, there's been a major rally on stocks leading into the announcement that we're going to have rate cuts. Okay, so the rate cut that we just saw is going to have a very large impact on the stock market, bullish most likely, and over time, not necessarily today, and this is why we've been kind of concerned about getting a really good entry or just not getting an entry at all on Bitcoin. And luckily, I got a really good entry that I'm pretty happy with. If we don't end up getting a really good entry, then don't take the trade. That's fine. You don't have to trade the Fed meeting. It's extremely risky. I am fully anticipating just getting stopped out of this trade. It's fine to me. I don't really care. If it happens, it happens. I use standard risk, so I'm not using, I'm not risking a huge portion here. And if we profit, then we end up profiting 3 times as much as we were originally risking. So bottom line is this. The Federal Reserve cutting rates and ending QT is overall a net bullish impact on the Bitcoin market in the long run. However, and this is why you need to be careful about going long right now and why I'm taking a risk and why I didn't take much of a risk. I just took a little bitty trade because I want it to be something that we can talk about here on stream. The reason we took this trade is not because I actually like trading the Fed meeting, because I don't, because it's really difficult to figure out whether you're going to be able to profit or not. The reason I did this was because if you come here, the reason I took this trade, I want to explain why I took this trade now. I'm trying to get as much of this out of the way as I can before Powell speaks. The reason I took this trade is because of this channel. You can see, if we consider this an outlier over here, what you will see is that Bitcoin just dropped down here to the bottom of this trading channel. And so my trade setup, as I'm in right now, has an entry. Let's plug these in. An entry price of 111168, I think it is, right? So let's grab our trade entry over here and look at it. Let's see. We got our TPSLs over here. 115, 800, 109, 600. 115, 800, 109, 600. 800, 109, 600. So I want to give you I want to explain to you why I went into this trade at this level and why, even though we're kind of right here near break even, I'm not really bothered. Because it is fun to try and trade these things. When you have a lot of volatility, it's a great opportunity to get a trade in. So entry price, 111146. Do we have that right? 111146. So these are our exact numbers. You saw it yourself. These are our exact numbers of the trade that we are in right now, and I'm going to explain exactly why I took this trade and what I expect to come of this. And we'll kind of talk about this in the technicals moving into the actual speech. And then when the speech comes on, I will, for the most part, be quiet. I might, be like, wow, or that's important or something. But overall, Powell will probably speak for about 10 to 15, maybe 18 minutes. And then he will go ahead and move into a time of Q&A. And we'll catch the first bit of that Q&A. I think I'm going to have to bounce at 3. But we shall see. So why did I go into this trade? And right now we're basically at my entry. So, you can consider the same trade. The reason I went into this trade is because in this trade, I have the ability to set up a pretty strong risk to reward ratio. I have a 3-to-1 risk to reward ratio, which means I have 1 R as opposed to 3. I have 1 R of risk as opposed to 3 R of reward. And I see that there is a great deal of support down here between 2 major levels, and that would be the last 2 of the all-time highs that we saw this year. We saw an all-time high at 112, at 109, and at 112. I think what often happens is that Bitcoin drops into the middle of zones like this, right? And so if Bitcoin drops smack dab into the middle of this zone, well, guess what? I'm not stopped out. My stop loss is lower than that. On top of that, if Bitcoin does drop down here below this uptrend, it's probably just, it's very possible it's just a scam wick. So I've got my stop loss low enough to capture all that. And on top of that, I've got my stop loss just a hair below this bottom right here. I managed to catch almost the exact bottom. So I got a really solid entry. And then after I've got my stop loss figured out based on technical analysis, all these different support zones and whatnot, and even down here, we got visible range volume profile. We talked about this entry on stream this morning. Even down here, you see, if we look at the last 2 months or so, there's a great deal of visible range volume profile support defending us at 111,200. That's why we're sitting here, right? There's a boatload of support down there towards my my stop loss. So very, very, very strong set of confluences for our stop loss. Very high probability setup, especially considering if you look at CoinGlass, I told you guys you're going to see some whipsaw action today. Like, we posted about all this on stream. If you're following me on Twitter, you've seen this. Like, we called on stream for a drop. I took this chart, I took this picture this morning on stream. Bitcoin was sitting at 113 when I actually started talking about this. I said it's going to go down to 111. That's the bottom of the channel. That's where we put an entry. It's exactly what I did right before we went on air. That drop has taken place. We also said this, y'all, there's a lot of liquidations right above us and below us. Short squeeze, long squeeze, over $100 million today incoming. Which direction do we go first? I asked myself that question and thought about it quite a bit. And I said, today will be one of the most volatile days Bitcoin has seen in a very long time. Fed will cause the price to whip around like a crocodile with a T-bone steak in its mouth. And that's exactly what we did. I also said the CME futures gap is partially filled, but its gaping maw is still wide open. Lots of long liquidations in there too. Yikes. So far, we have been spot on with everything that we've called today. We called for a correction moving into the Fed meeting to eat these shorts for breakfast. Sure enough, they all got eaten. Part of the reason that I put my entry down here, if you'll notice, the vast majority of those long liquidations went down to 111, which is where I put my entry. There are some long liquidations down here, but now you see the difference. Look at all these short liquidations up here the market's going to want to eat. There's not as many long liquidations because people are too scared to go long right now. On top of that, the other technical confluence, why we did this, and again, we can be wrong. That's part of trading. You're going to get wrong sometimes. Sure, maybe we get stopped out. The other thing that's exciting to me is that the CME futures gap, the bottom of it, is at 111, 190, right? This is not updated. It didn't go all the way down there, right? But Bitcoin, strictly speaking, did drop down below 111. Okay, so technically speaking, it's not showing on this chart. Hopefully it'll update. If not, we might need to have another correction. But technically speaking, we did fill the CME futures gap. I don't know why it's not updating on CME's actual chart, but we did fill the CME futures gap. And you can see our stop loss on this trade is right here, well below the bottom of the CME futures gap. So I personally believe, and we'll see. I don't know. We'll see. Maybe I'm wrong. But we're using proper risk management. You can see I have a reason for what I'm doing. I have a feeling that we're going to be able to defend that. Maybe not. Maybe not. Maybe we crash. That's fine. I'm not risking more than I'm willing to lose on that trade. And something you have to keep in mind is that when you enter into a trade, you are putting whatever you're risking in the trade up for, you're putting that up as basically a cost to be invested in the market. Most indicators say we're at the bottom. Yeah, the vast majority of them are saying that the bottom was around 111. You can even see here, for example, hourly chart RSI dropped down to 28. That's one of the lowest levels we've seen in a very long time. Typically, we don't spend much time down there. If you look at MACD, once again, is also at one of the lowest levels that we've seen in a while. It is a very strong technical setup for a long entry at 111, 146, which is where we ended up dropping to. So we'll see. We're going to let that trade ride. We've got it right here. It's up, down, you know. This is it. You can see the little arrow for the entry. A little arrow entry. That little arrow right there signifies our entry. By the way, we're on 2bit. If you guys want to get access to our first cohort Discord server where I talk about trading and where you get the first cohort, where you get different videos early, make sure to sign up for 2bit with the link in the description box down below, and you'll get access there. Don't really like what I'm seeing on the 1 minute chart right now. This is relatively bearish looking. It's possible that Bitcoin tries to create another move down. We could say that this is a 1, 2, 3, 4, 5 wave down. So it is very possible that Bitcoin moves lower from here. I've got my stop loss down here. I think there's a very real possibility that we approach that stop loss. So I do want to say that. Very real possibility that we approach that stop loss because of this 1, 2, 3, 4, 5 Elliott wave pattern. We have a simple corrective wave. It's a short Elliott wave. So in this case, it's this. So we have a simple and we have a complex wave, for example, here. If this is the 4 wave as well, then we would also want to potentially pull a Fibonacci here to figure out what we're looking at here. I'd like to see Bitcoin hold. You see? I'd like to see Bitcoin hold that 0.786, but that is a little bit low. So that's telling me that this market looks like it could fall over and start moving towards our stop loss. Like I said, though, I've set this stop loss up really deep into bullish territory and still maintained a 3-to-1 risk to reward ratio. So overall, I'm still very happy with our current setup. So yeah. All right. So like we said, rate cuts have been announced. For anybody who just tuned in, we have the official announcement. It is right here. The Federal Reserve has decided to lower the target range for the federal funds rate by 1/4 basis points, right? And on December the 1st, they are going to be ending quantitative tightening. Now, the market probably hasn't fully responded to this yet because most people don't know how to find this. They don't know where this press release is. They're waiting for the actual speech, which is what we are going to be watching right here live in 7 minutes. So stay tuned because we are going to be watching all of that take place live here on the channel. Once again, very possible we get stopped out. If we do, that's fine. It's the Fed meeting. There's always a huge risk of this. Very, very risky trade. But ultimately, the market is almost certainly going to whipsaw back and forth one way or the other. Why not have a trade open with a good solid risk to reward ratio to go ahead and at least have a shot of capitalizing on that. If we lose, we lose. No big deal. Not too worried about it. Let's see. So let's read a little bit of chat. Like I said, we got 7 minutes until Jerome starts speaking. Be careful, that might be a double top on the monthly chart. Looks like it. Yeah. Hey, we still have a prediction of 94,000 to 100,000. We never closed out that prediction. When this market pumps, it'll leave a lot of people behind. Sure will. November 1st might be the big dump day. Not financial advice, just an educated guess. Most indicators say we're at the bottom. What I will say is that the sentiment in the Bitcoin and cryptocurrency space right now looks a lot more like the bottom of a bear market than it does the top of a bull market. I will 100% say that. This does not feel like what the top of a bull market feels like. I have been through 2 bull market tops. I'm talking about before the halving cycle, before the 4-year halving cycle bear market. I was there. I was looking at my chart. I watched Bitcoin hit $20,000 in 2017. I watched it with my own eyes. I didn't look at it in history. I watched it happen live. I was there. I also saw Bitcoin hit $69,000 last year, or last cycle, all-time high live, and I remember that day very well. You know why? Because that was actually the day I met my wife, was literally the exact day that we hit the all-time high. So, it was the all-time high of my life, meeting my wife. So I remember that day very well, too. So I remember watching the chart both times. I don't know if I watched it like the second time, but I saw it happen the first time. I was watching it. I remember what it feels like. It does not feel like that right now. It really doesn't feel anywhere near like that. So, will you live stream Chair Powell? Yes, we're going to be watching that here in just a few minutes. Louis from SA, time to pump. What's up? The announcement, totally not bullish. We'll see. We'll see. The end of QT is typically very bullish for markets. Before we actually have to look at the watch Jay Powell speak, let's look at the history of that claim. Let's look at the history of the United States Central Bank balance sheet. Let's look at that. Look at the history of the balance sheet, right? When you saw quantitative tightening end, there's only really been a couple of instances of that, and they were very much smaller ends than this. This is the largest stop to QT that we've ever seen. I mean, this is the QT. It's like $4 trillion tall. It's ridiculous. $3 trillion tall. The last time we saw anything like this was right here. This was the end of QT. Bitcoin, sorry, not Bitcoin. The stock market, not even just Bitcoin, ever since the end of QT, the last time, is up 114%. Annualized stocks have grown like 22, 23%. And so it makes a lot of sense that the end of QT would lead to a major rally. It does. The reason it makes sense is because money just got cheaper. I mean, it's that simple. Money just got cheaper in the stock market. It's easier for people to access capital. Very simple. So we don't have a whole lot of historical precedents to go off of, but I'm going to lean in the direction of saying that the end of QT probably is a bullish factor for markets. All right. Now, like I said, here in a minute, I'm going to shut my fat, ugly mug, and we're going to listen to what Jay Powell is going to say. One fat, ugly mug to another. Good picture of Jefferson Memorial there. I've been to D.C. a bunch of times. It is gorgeous. I'll tell you what. D.C., that area, absolutely beautiful. We spent quite a few days up there in February of this year. If you've never visited Washington, D.C., it is worth a visit. The museums there are incredible. I'm a big fan of the Natural History Museum there as well. They have I have a picture of it in the Natural History Museum in Washington, D.C. I'm sorry, not the Natural History Museum. The Aerospace and Aviation Museum. They have an actual full-scale replica of a TIE fighter. Not a TIE fighter, an X-Wing from Star Wars. I'll show you a quick picture, and then that'll... Look at this. Let's see if I can... Yep, this. I've seen this in real life. This is pretty cool. If you're a Star Trek fan like me, that I was giddy. It was just awesome. All right. like I said, we are going to get ready here for Jerome Powell to start speaking. I'll turn my mic towards this, and we will go for it. Jeb, will you sell everything of your alts in this bull run, and will you keep some to the next cycle? If altcoins blast off way above their all-time highs, I'm going to take profits, because in the long run, I prefer to be on Bitcoin. I would love to sell my altcoins if they're up against Bitcoin and just use it to buy Bitcoin. You think we'll immediately start pricing in the end of QT once the confirmation actually hits the market, or it could take a while? That's a great question. That's a great question. I'm not 100% sure. I'm not 100% sure. I think it might take a little bit of time, because let me try and process that. I don't know. I'm going to think about that. Let's see what gold's doing real quick while we still have the ability to look at charts. Ooh, that's rough. That's no good at all. That's an overside underside test on gold. Dropped down to 38.84, 38.82. Wow. This could very easily be an Elliott wave 1, 2, 3, 4, 5 pattern. 1, 2, 3, 4, 5 down towards the daily chart. SMA. Now we're not gonna do too much analysis on gold right now, because once again we got to get ready for the Fed meeting. Huh, look at that. There's a bucket that went in front of the camera. Oh my goodness. All right, bull run is over. You think so? I don't think so. I don't think so. I'm personally not of that opinion. You can think whatever you want, though. By all means, be a free thinker. Be a free thinker, my friend. Let's listen to what Jay Powell's going to say. I'm going to pull my chart up on Bitcoin over here on the other screen. And if it just pumps straight to the moon, we're just going to be sitting pretty. Be sitting super happy. Oh, wait, hang on. There we go. I'm going to go ahead and build out the stream in a way that it looks a little bit better. Any second they'll be starting.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1.
There you go.
I will have more to say about monetary policy after briefly reviewing economic developments.
Yep, end of QT.
Available indicators
Confirmed.
suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months.
There you go.
Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion.
Not stopped out yet.
Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Wow.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have a situation where the risks are to the upside for inflation and to the downside for employment.
That's
you have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that it's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice. And so there's not a lot of benefit to be holding on to get the last few dollars because, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
People are so scared they don't know what he's saying. I'm going to explain in a minute. What he's saying is extremely bullish.
Thank you, Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings. And we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December? Yeah,
so we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or a material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views? Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
Just to follow up on the balance sheet, if you stop at the runoff now, does that mean you have to go back to actually adding assets sometime next year?
He asked it.
Balance sheet doesn't shrink as a percentage of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in treasury bills, which will foster both a more treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing.
He said it.
To keep up with the size of the banking system and the size of the economy. So we'll be adding reserves.
He said it.
Point. And that's the last point. Even then,
he said it.
We'll be. We didn't make decisions about this
today.
QE. We did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be. Right now, it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint. But we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually.
Okay.
I don't think you'll notice it in market conditions, but that's the direction of things.
That's what he said. He said it. That's QE. Gradual, but he said QE.
With Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment,
he said it.
What are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on
translation? Stack Bitcoin because they're gonna crap on the dollar.
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally,
I told you.
It was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news, that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing
Mark is
services.
waking up to what he just said.
And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths. And so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that? And especially when we're seeing potentially labor supply challenges?
Sorry, say that first.
The stubborn services inflation that you mentioned.
Service inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. And so that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment.
Sure you are.
There should be no question that's where we're going.
He just said it was a credible idea that they're trying to bring inflation down to 2%.
Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all. And could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data, that isn't the gold standard, or that you're relying on your own surveys or the beige book? Do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate in this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things, that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs. And much of the time they're talking about AI and what it can do. So we're watching that very carefully. And yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well, the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth, that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, let's pause here, kind of thing. And a sense from others wanting to go ahead, but that's why I say differing views, strongly differing views. So on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have in fact cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
There you go.
Elizabeth. Thank you so much. Elizabeth Scholzley with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are 1/10 or so on inflation.
That's right.
They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think
there you go.
Some projections go, we're at 2.8% inflation. You might get
Jerome Powell just admitted Trump was right.
4 more tenths, maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
Ooh.
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. And you don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not, it's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last
That's
few
a
weeks.
great question.
Yeah, I don't think interest rates are an important part of the AI, of the data center story. I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about, it's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here to, by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria.
Sorry for the loud laugh,
Rita
guys.
from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the .com, these are ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models, and and profits and that kind of thing. So it's really a different thing. It's the investment we're getting in equipment and all those things that go into creating data centers and feeding the AI. It's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher end consumers or maybe skewed that way, but the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You can point to growth. I mean, actually, maybe growth as opposed to level, but consumer spending is a part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that, where people need jobs because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course that will reverse. But, you still got the economy growing at a moderate pace.
Andrew.
All right, I'm going to go ahead and take it over from here just because I want to make sure that we can actually kind of surmise, and I got to wrap it out. But I think he's pretty much covered all his bases. Big takeaways here are, number one, you are seeing a rate cut this month. Number two, you are seeing the end of quantitative tightening. We're going to go over all this briefly here. Number three, you are witnessing the likelihood that you're going to see quantitative easing begin gradually and slowly at some point over the next over the course of maybe the next year or so. He's very vague, but he did say that the logical next step would be to the expansion of the balance sheet. So there is some talk in this meeting about quantitative easing, although it is he very much marked it as something that would probably be relatively slow. And then also there is the kind of the central topic of conversation for this meeting was the discussion about whether or not there's going to be another rate cut in December. So we have CME futures right now predicting a 65% likelihood for a rate cut in December, but Jerome Powell definitely seemed to be trying to signal to us that there is a serious possibility that will not take place. So this is far from a foregone conclusion, the idea of the rate actually being cut in the month of December. So there's a possibility that we don't see a rate cut in December, and that's something that we need to prepare ourselves for. So overall, our projection that they were going to kind of move very aggressively into rate cuts, very aggressively into QE, that's something that we're going to have to temper a little bit. But overall, it is still a pretty good outlook for the United States stock market and also a relatively strong outlook for the Bitcoin market. As far as the short-term analysis is concerned, Bitcoin put in a scam wick down here. It's called a liquidity hunt, and we got stopped out. I immediately went right back into the trade because I was pretty confident in it. But Bitcoin ended up having a drop here. You can see I was watching this on our other screen. Bitcoin dropped right through here, hit our ridiculously low stop loss right here. Decided to go right back into the trade right there when Bitcoin started to reverse. So we are once again in that trade. And we are currently up about 14% or so. Laddered into it a couple of times while Jerome Powell was speaking. Have a liquidation down at 108. Entry price around 110, so I quite like that entry. Gonna let that run for a while. But overall, here's what we need to see. We are looking right now at a 2026 that is likely going to be marked by a couple more interest rate cuts. down towards wherever the neutral rate is. It might be an every other meeting kind of cut. There might be that kind of trend, right? And then you're also going to see the ending of quantitative tightening. At that point in time, you're going to have to see what the market does. If the market is strong, then that's good for Bitcoin. Like, we don't have to see quantitative easing, and we don't have to see interest rates down at zero for the Bitcoin bull market to blast off. Because in general, actually, when you first go down to those levels, in the short term, not the long term, but in the short term, it's actually not great for Bitcoin, because if the interest rates are down at 0%, that means you're basically in a recession, right? So in the long run, 0% interest rates, not in the long run, in the short run, 0% interest rates are not exactly the best thing for Bitcoin in the early days, because as you're cutting the interest rates, people are like, oh crap, the economy's not doing great. And that's part of the reason that as these rate cuts are coming in, Bitcoin is kind of slowed down, but that's going to stop when the rate cuts stop. So when rate cuts stop and they say, okay, the economy seems strong, we don't need to cut rates anymore, we're down here at the neutral rate, what you'll see happen is that in theory, if what the Fed is doing works, then you'll see the stock market start to fly. If the stock market starts to fly, then what you'll end up seeing happen is you will end up seeing Bitcoin most likely follow it. So pretty encouraged by what was said at the meeting. He did confirm that QT is going to be ending as we anticipated. We also have confirmation that Jerome Powell feels that the balance sheet and the funds rate are approaching the level that they should be at to sustain long-term growth in the overall labor market as well as the security market. So what all this means is that you are most likely going into a period here. Make sure you guys can see me. My got a little bit of a glitch here. Hopefully you guys can see me and something didn't just mess up. There we go. Okay, yes, let's fix this now. So overall, what this means is that the United States stock market will likely be in pretty strong shape next year. And the reason that that's so important is because if the United States stock market is in pretty strong shape, we know that Bitcoin is generally speaking we know that generally speaking, the United States stock market is quite heavily correlated with the Bitcoin market. So as the market starts to move in a direction that is conducive to growth, then that will most likely help Bitcoin just in general to perform quite well. So obviously, this is something that I was kind of anticipating. That's why I had such a low stop loss. I almost had it low enough not to get stopped out, but oh well. We ended up going right back into it. We might be wrong. That's okay. That's fine. We learn. But one thing that I'm going to learn from this is that just Jerome Powell saying good afternoon, crash. People are like, oh crap, Jerome Powell is speaking. And I think the big takeaway I want to learn from this as a trader, trading future Fed meetings, is that whenever Jerome Powell or anybody on the Fed chair opens their mouth, it doesn't really matter what they say. The whole market freaks out. Like the whole market just says, oh crap. It's kind of like you got called into the principal's office. It's like, you might have gotten called in there to win the Nobel freaking Peace Prize, but just the fact you got called into the principal's office makes you crap your pants because you think, oh my gosh, what did I do? What's wrong? Just hearing him speak is terrifying. And so I think as the world starts to understand from different analysts like myself what he actually said, then the market's actually going to do pretty well as a result of this, because Jerome Powell says that, okay, we might be approaching the neutral rate. We may not need another rate cut. Overall, thinks that the economy is going in a good direction. If that's true, which is definitely debatable, I think some of the things that he said was absolutely laughable. But if the overall market adopts that stance that, okay, things are good, then you will likely continue to see more investment in stocks. You will almost certainly see more investment in Bitcoin. And overall, you will probably see Bitcoin perform pretty well from here. It's also interesting to note what happened to gold during the speech. You saw that gold dropped from 39.88 all the way down to 39.42. This was a drop of about 1%. So hope you guys enjoyed today's stream. I got to wrap it out. If you are new here, make sure to hit that like button and subscribe to the channel. I really appreciate all of you for being here. We will continue to post more content about the effective federal funds rate decision as the week goes on. I really believe that we're going to see a bullish 2026, but we will keep you up to date on all of that. Before I go, I do just first want to thank each and every single last one of you for watching, as always, and I will see you guys in the next video. Peace.